Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show. We're back at it after about a month hiatus, and we're going to have our normal 3 segments. And when we look at the 3 segments, we want to look at how shoulder season is starting off. And our little kitschy thing is it's starting off with a bang. When you look at how the pivots are happening, especially when we start looking at the refined product side. And for those that remember from the conversations that we had in August, our view was that gasoline was going to continue to build, but we was going to stay flat, and then we were going to get some unseasonal builds that was really going to put us in a much better position, and actually probably above the 5-year average as we would head into Q4. That has so far played out. We want to go through that a bit more in segment 2. And then in segment 2, we're going to look at refined product demand. Some of it is timing, and we want to look at the timing and why that would be the case and how we think that's going to shape up, especially if we have a normal to colder winter. Then we're going to look at Russian crude exports. They continue to increase, and even as kind of that global demand softens. We have China, which had its Golden Week. It started this weekend, this past weekend, or Friday, depending on how you're celebrating. And we want to talk about, okay, well, that's a nice little bump. Where are we going to go from here when we start looking at some of these pivots and some of these shifts on the global market? So getting right into it, as always, we want to really kick off with what's happening in the floating market and the global crude markets in general. Global crude oil on the water continues to be very elevated, which isn't surprising given, obviously, we haven't seen pipelines coming back anytime soon in Russia into Europe. So there's just more going abroad. And as we've been saying, it's going to stay at this record-setting pace, and it will likely accelerate. And it's not going to accelerate because demand's going to go up. It's just typically when we start getting into that October, into that December period, you normally see more crude on the water. So it's just going to move above at that higher level. So we do see the market closing out at an all-time high with crude oil on the water. Crude oil in transit remains elevated. We did see some cargoes cross. Now, we have to talk about what's happening with price. When we look at crude, and we're going to talk about Brent for a moment, our view is that the Brent range for September into October was going to be 88 to 96. So obviously right now as we're recording this, it's sitting at 87. It's dropped about almost $4. Realistically, when you look at the physical market, and for those that have been following our insights, we've been saying it's like, the physical market isn't supporting a push to 100. But it's also not pushing for a huge drop to 80. There's some in between here, and the question's going to be, where is that in between going to kind of settle out? You had a lot of macro PMs that were grossly long. They were, and it's usually a pair trade, so they were very long. It was time to lighten up. You had Russia that has pulled back on exports of product, increased exports of crude. So you're starting to see a bit of a right sizing. Now, we do think that as this selling pressure dissipates, you'll drift back up to about 90. But realistically, longer term, and by longer term, we're just going to talk about 2023, the rest of 2023, there is way more downside. And the reason why is because of demand and because of the slowing down consumer and that underlying piece that continues to kind of bite at the heels of the bullish side. But when you look at OPEC, and when you look at Russia, when you look at Saudi, overall between CN, between limitations, between cuts, there's a sizable amount of crude that is currently off the water. And that's why we're staying here. Because if Saudi Arabia came out and said, yep, we're going to bring back 1 million barrels a day, we're dropping $10 on the announcement. So you have to put that into perspective. And what is Saudi going to do to try to keep this and bump this higher? One of the things, we had a great question from one of our long-term followers that we answered in some of the other areas, but we wanted to touch on again how Russia was trying to try to manage retail prices. So as we were saying, is that they were going to likely ban or at least limit in some shape, way, or form exports of refined products, which they have done. but they're not seeing the same level of decline because they do have a war effort. You know, it takes a lot of diesel and gasoline to maintain a mechanized force. There's a lot of things behind that are going to continue to be problematic when you look at how they're trying to manage themselves, especially when you factor in the loss of equipment because of the extended downtimes of the refiners in Russia, you know, struggle of getting catalysts and other key components to bring their systems back. And they don't want to risk shutting in crude production. So again, that's going to put more crude on the water, limit the amount of refined products that they're going to be able to export for two reasons. One, because there's just less to export. And then two, as they try to bring down some of those prices. You know, they've brought them down a bit, but it's not in an area that, you know, they are going to deem successful, which is why we will see that come and more pressure come with product coming from Russia. Global crude oil floating storage, as we were saying, you know, it's going to stay above that 2022 level. We don't really see it being at 2021 levels. Our view, and for those that have been following us, our view is that we were going to kind of split the uprights when you look at that 21-22 level. 2020 obviously was a crazy year. That came back down at this point. But you're going to see us kind of filling in that void that exists between that 21-22 level. And that's where we're gonna see those builds, especially as we go into the end of the year, where you have a little bit more excess in the water in general. The crude oil supply adjustment was a bit higher this week, and a lot of that is driven based on where are exports, where are imports. Imports had a big drop. Exports had a decent rise. So again, that kind of created some of those shifts, and we do see that reversing a bit. And typically, as you can see from last week, as we've been talking about, as you get to the end of the month, you usually have that catch up, and then you have another little bit of an adjustment in the first week when you look at some of the shifts and as the data trues up, especially on the import-export side. Crude had a draw. We had a draw of 2.22 million barrels. That brings us 33.4 million below the 5-year. But remember, it's really driven by Pad 2. Pad 2 was dropped to 1.02 million. That's down 18.4 million versus the 5-year average. And then Cushing was up 130,000 barrels, but it's still 14.2 million below the 5-year. And that's just because you have that drop. But remember, you know, Cushing was bypassed as we got into 2018, 2019, as you had more pipelines that were targeting the Magellan, East Houston, you know, and the export market. So you're really bypassing some of the relevancy behind Cushing. Not to say that you should ignore it, because it is a tank farm, it is storage, but it's just important to put it into context. Pad 3 had a drop of 1.64 million. That's still 4 million above the 5-year average. And a lot of that is going to be that back and forth. But then the question becomes, well, how much of it is going into Pad 3 instead of Cushing? So that's why we always like to try to balance things out when you're looking at where some of these tank farms are, where a lot of the storage sits, and especially when a lot of it is being directed into the export market. When you look at the SPR, there was a small build. So the aggregate with SPR was only a drop of 1.92 million. You know, when you look at crude production, where it still has us about 12.9 million barrels, we still think that's a bit on the high end, but we have seen a bit more of this dual frac, simul-frac rolled out, and this is something that we've been talking about on the FSC, on the frac spread count side. When you look at crude oil inventories, excluding SPR, you can see that we're coming to that low point, and this is where we normally start to see a bit of an increase in storage. When you look at the slowdown in refined activity, a lot of that, again, is seasonal. When you look at, we're heading into peak maintenance season, which is when we'll start to see some of these builds in general as you start to prepare for the winter turn on, which comes towards the end of October, November, when some of these refiners have been reconfigured and come out of their downtime. Total U.S. commercial oil storage and products, you can see it's flatlined a bit. We're just above where we were in 2022. we don't see too much of a shift down. If anything, we start to see that creeping higher. And a lot of that is just going to be less crude demand with refined products, refiners coming down. And because the consumer has been slowing, that's again going to put a bit more product into storage and will likely push us closer to where we were in 2021. As you can start to see, this is where in 21, that yellow line just above, you start to see that pivot, and then we should start to see a bit of that rise moving higher. Crude oil inventory, pad 3. You can see here that we're right at where we were in 2021. That's, again, we don't see too much of a pivot here. If anything, we should start to see a bit of an increase. And seasonally speaking, that you usually start to see a bit of an increase. The problem for us is we're starting a bit higher than when we normally start to pivot higher. And that's, again, where we're going to see a bit more of that. The exports are going to remain strong. We did get OSPs, official selling prices, where Saudi kept things elevated. Libya increased things over $1. So there's still tightness in the market when you look at the physical side, which is going to support additional crude from the U.S. Now, when you look at crude oil in Cushing, here you can see that we had a sizable drop, and the rate of change was pretty extensive, but now we're starting to flatline. And if you look at where we were in 2014, this is where we kind of flatlined and started to pivot higher. So realistically, as you have refining maintenance coming in, refiners reducing activity, we should start to see this increase as well. But it won't be a huge surge. It's just going to be a steady rate, and we should close out at that 17 or so year average. Now, when we start looking at run rates, as we were just talking about, here you can see that the runs dropped 463,000 barrels. That's 2.2%, and a large part of that was in pad 3. And it's this, seasonally speaking, this is when it's supposed to happen. You're supposed to start to see some of these reductions in general, which is what you can see in this chart, where we're just following the trend. We're a bit more aggressive on the slowdown, and a lot of that has to do with gasoline, some of the crack spreads in general. But you can see that we're seeing that nice drop, and then we'll start to flatline as we get to the next week or the week after. In terms of in October, we'll flatline at about that 85% level. We'll finish that work, and then we'll start to see some of that come back as we head into the end of October, into November. So again, very seasonally normal. We're just on the lower end of seasonal, where there's a bit more turnarounds than, or I should say, timing in terms of where it is at the moment. Imports had a drop of just over 1 million barrels. That's we're now 161,000 barrels a day below the 5-year, but still above the year-on-year. The Midwest had a drop of 466,000 barrels, or pad 2, but you can still see it's still above the 5-year. That's going to be a bit lumpy, but we should see that stay at these levels and maybe bounce back a bit to about 2.8 to 3 million. Pad 3 had a drop of 330,000 barrels. We should stay between that 1.2, 1.3. And a lot of that is just because there's not as much refining capacity. You have that slowdown. But pad 2 doesn't have the same maintenance schedule. Things are going to be a bit more active. So pad 2 should stay a bit elevated, but pad 3 will come down. And then pad 5 being a bit lumpy. They only dropped by 89,000 barrels, still above the 5-year. So we should see that, again, bouncing around a bit with typical seasonal norms. Pad 3, as we were saying, going to stay below that 5-year average. We got that nice little spike, but here we're settling back out. We're just we don't see us falling below that cloud there. Instead, again, staying within that band between the averages. Pad 2, seasonally moving back and forth. Here, still above the 5-year average. We do expect to see a bit of that bounce, as it still makes sense to bring down that Canadian crude into Pad 2, especially given the distillate story that happens in that region. Now, implied demand was interesting. Here you can see gasoline had a big drop of 605,000 barrels a day. We went from 8.6 to 8.8, pretty much 8 even. And that's a drop of about 1.1 million barrels per day against the 5-year average. But you have to think about where pricing is. So prices have absolutely collapsed. And because things have collapsed, if you're a retailer, well, why are you buying? Like, there's no rush to buy things. So if you're not buying because you want to see prices come down, This is looking at not so much the customer that's putting their credit card into the machine, but more what is going from the blender to the retail entity. And things are just kind of stuck there because people are like, look, I'm waiting for prices to continue and start to settle out. And that's where we're continuing to see some of these backdrops. So that's a long way of saying we're going to bounce back up. It'll likely bounce because we're probably closer to 8.4, 8.5. And that'll be a bit more normal versus where we are. Still be well below the 5-year average because we're only bringing back, in our opinion, 400 to 500,000 barrels, which is still, half of that 5-year average. So it's still a big problem. Distillate continues to be soft, drop of 157,000 barrels a day. The UAW strike is having a much bigger impact than I think people initially perceived. We have a good chart on that in the next segment. Jet is sitting at about 1.7. Now, we should be a bit higher here. If you remember, we were saying 1.55, 1.65. We're likely going to be between 1.6, 1.7. Just we do have a bit more travel. Things are a bit more normalized. And seasonally speaking, we start to move a bit higher as people try to get their business travel in before the end of the year. And then propane, propylene bounced 180,000 barrels, still very low. And a lot of this is still going to the export market, which we're going to talk about in segment 3. Then when we look at gasoline demand, again, you can see that this big drop, we're below where we were in 2022, even 2020. Realistically, we should be where we were in 2020. That again, this drop is too low, but we're still not talking about a great demand situation. That we're kind of splitting hairs here. It's still at a 10-year low. And for those that have been following us, and for the critics of ours that said when we said in 2021 that there was a structural change in implied demand, and we were told that we were missing the forest for the trees, it's like, well, the data is here. Like it's playing out as we were saying. It's just people aren't going to the office the same way. They're not traveling the same way. There's economic slowdowns. And here's how things continue to play out. Now, as we look at days of supply for crude oil, you can see that things are still fairly normal, especially as we have refiners ramping down. That's going to put some additional into there. Gasoline storage, this is how things played out, starting kind of sideways. And then our view was that instead of having a drop in storage, we were going to actually have that counter-seasonal bounce. We thought it was going to have 1 or 2 counter-seasonal bounces, then go sideways. Excuse me. And then based on the storage getting easier, or the comps, because historically speaking, you have a decline in storage. But instead, we're having an increase. So because the comps are getting easier, it's looking better and better. And now we're actually well above the 5-year average, which we want to talk about more in segment 2. Distillate still continues to be in a tight spot and problematic, especially when you look at how things are sitting in pad 1, how that's going to set up as we go into the winter months. Jet fuel continues to be at a fairly normal standpoint as things try to get balanced. Now, this is an interesting one when you look at the futures curve. So the futures curve here is showing on how everything shifted higher. Now, one of the things that we've talked about, and we got some pushback on this, was that it's a bit difficult to be playing in the front month because the front months are sloppy. There's a lot that is, and we had said that going further down the curve is a better place to kind of play around. And there's 2 months, when you look at January and June, are good months to kind of play with because they have the most volume in those out years. And it's just because, even though we may be bullish, bearish at different times, the front month, we still think that there is an opportunity in those out years, and this just goes to show that example. We have seen some softness in the curve in general, and we'll likely see some of this come back down. And then whenever Saudi brings back production, whether that's the beginning of next year, the end of Q1, we'll likely see some of these movements. But in the meantime, we'll continue to see some of this activity. Floating storage in the Gulf has bounced a bit. So again, it's that timing delay. Back to our comments about flows. So you saw a big increase in imports, went above the 5-year average. We said that was temporary. That'll pull back down. And here, because we pulled it off the water, and here's where we continue to kind of balance those different approaches. So that's what we have for you in segment 1. In segment 2, we're going to go deeper into refined products and what we're seeing on the demand front.